Let's go right to our floor show, find out how investors should trade all of this action. Joining me now are traders Scott Shellady and Tom Hayes. And Tom, I'm going to start with you on this one because Powell once again reaffirming that this is the path they're on. But I have to say here, what I found interesting in his comments is today he said, look, but this is data dependent. We're going to get more data before the March decision. So I think he kind of clarified today in his comments, this isn't set in stone that we're jumping a half a point at the March meeting.
That's right. Well, Powell came out strong. He said faster, higher, longer, and the algos went crazy yesterday. We saw that. He also said that services inflation is sticky, so that was also bad news. And then the dot plot is, basically implied the dot plot's going to go up from 540 terminal to 565 in that range. That's the bad news. The good news, to your point, Cheryl, is that all the inflation, and he acknowledged housing, wages, et cetera, goods are coming down. The only one that's sticky is services. He did say we're going to stay data dependent, and he did leave on the table the possibility of a soft landing. So the market took it hard, but they're going into a blackout period.
I was going to say, I do think that it was because of the language that he used yesterday, Scott. And I want to stay on this really quick as well, because so many investments in commodities, which you know very well, are interest rate dependent. We've seen a big change in oil. I think part of that was some other comments that came out today, but we really are seeing a little bit of a trade in oil as well. And then also, too, I think, the economy with the China reopening story, that pressure coming from China is another story. And he was asked about that today.
Well, I think that the China reopening story obviously is there, but I don't think it's as strong as people think it's going to be. I mean, they're still limping along as well. And I think that what I heard from the Fed today and yesterday, for Jerome Powell today and yesterday, was a lot of what he's been saying already up until now. Was he maybe a little bit more hawkish? I don't know. At the most, maybe. But I think that the market has been Pollyannish, whistling by the graveyard, ignoring what he's had to say. And maybe it's because he was in front of the Senate and the House this week, these last 2 days. They've stood up or sat up and taken notice. But yeah, to say you're data dependent, big deal. I mean, I don't think what he said was anything shocking. I was shocked more about how the market hadn't reacted to it for the last 6 weeks. And to Elizabeth Warren's point, I would have also liked to see, and I did this on my show today, what would I have liked to heard the Fed say or Jerome Powell push back on? You know what? I don't need to be raising rates like I'm raising right now if you keep spending like you're spending. You know what? He's got a 2% inflation target that he's trying to get the CPI down to, right? We all know about that. We've talked about it ad nauseum. But I tell you what, how about this? How about the Congress? They can't spend any money until we get down to 2%. How about that? I mean, I think that would go a long way. Number two is, you know what? If we can get that oil price down, number one, it's going to help inflation in our country immensely. But number two, it's going to hurt the people that are now making a lot of money, i.e. Russia, because of high oil prices. It's a double whammy in our favor. So I would have a lot to say there. Obviously, you can tell I'm kind of worked up about it, but I thought the market finally reacted like I thought it should do today and yesterday to something that's been going on for 6 weeks.
Yeah, and Tom, I think the other good point, and I'm glad he brought that up, is that when we talk about inflation, and really that is the name of the game, and that's the entire story here for Jerome Powell. I mean, everything else just seems to be off the table. But he's not going to say that. He can't. But if you think that is the culprit, and that is stimulus spending out of Washington, which has not been reined in. We're going to get the president's budget tomorrow. It's, going to have a rough go in the House, obviously, and probably will not get passed because Republicans control the House. But that spending is where we're seeing that services inflation come from and come in. Also, too, the small businesses that are having to pay more, that's a drag on small businesses when they're having to pay more in wages. And we'll get the jobs report Friday, and we should get more, data from that level as well.
Yeah. Well, I think he's got to keep long-term inflation expectations pinned. I think the idea of 2% anytime soon is a little bit aggressive. Volcker had a completely different set of circumstances. He had debt to GDP at 33% when he was hiking so aggressively. We've been at 120% debt to GDP. The last time we were here was 1948. And what the Fed did during that period to bring down debt to GDP is they actually let inflation run hot for 5 years. They let it run 3 to 5%, and we dropped debt to GDP. They inflated it away down to 60% within a handful of years. And I think that's the playbook. He's got to continue to talk hawkish, pin the long-term expectations, but you got to let the economy run a little hot so we can bring that debt to GDP down a little bit lower. And then, of course, like Scott says, we got to get them to stop spending, but good luck with that.
I know. Not that I don't agree with you, Scott, but I say good luck with that as well. That is very true. Final thoughts to you, Scott, on the energy space. Look, I mean, I know it's only March, but we're already looking ahead to the summer drive. driving season. Look, a lot of people that use heating oil over the winter, they were hit with high bills. Electricity and the CPI report, another big jump that we saw. I mean, that inflation side is not easing. And then here we go, coming into the summer months when gasoline's probably going to be a headline we're going to have to talk about by May.
Yeah, well, you're right, because that's part of the CPI that also really helps bring the CPI down, right? Oil coming from 90 down to 70 or even 65. And if it does rally back up, that's going to be another thorn in the side of the Fed. That's going to be something else that they're going to have to worry about. And I also would like to see, give me a CPI number that shows how much money people have in their pockets, right? Because I am sick and tired of hearing about how the CPI has come down because used cars have dropped, 20% in price. How many times do you buy a used car? Or how much your house has come down in price? Well, it doesn't affect your day-to-day spending per se. It might do on the way up, but not really on the way down. I want to know how much money is still in the consumer's pockets, because the things that they touch every day or every other week, like food and like fuel, those are the ones that really hurt the most. And just go to the grocery store and look me in the eye when you come out and say, I only had to pay 6.4% more this year than I did last year, because I don't think that's possible.
It's interesting because Powell, reaffirmed again and again about how it's core inflation that he looks at. I actually don't buy that. I think that the headline inflation numbers are just as impactful when they're making their decisions as the core numbers are. But that's just my opinion because I'm not in the meeting. But we'll see what happens when they do, of course, release that decision. Tom Hayes, Scott Shality, it was great to see you both. Thanks, gentlemen.
Thanks for having me.